What are the risks of a simple IRA brokerage account? Have you ever wondered what risks come with a simple individual retirement account brokerage account? If you are considering this retirement savings option, it is essential to understand the potential pitfalls. A simple individual retirement account brokerage account is designed for small businesses and their employees, allowing tax-deferred contributions and investments in various securities. While it has its benefits, there are some risks you should be aware of. First, let's talk about investment risk. When you invest in a simple individual retirement account brokerage account, your money goes into securities like stocks, bonds, and mutual funds. This means that the value of your account can fluctuate based on market conditions. If the market takes a downturn or a company performs poorly, your retirement savings can decrease. This is a risk you need to consider, as your future financial security may be impacted. Next, there are liquidity and withdrawal penalties. If you need to withdraw funds from your simple individual retirement account before you reach age 59 and a half, you will face a 10% early withdrawal penalty. If you withdraw within the first 2 years of participation, that penalty jumps to 25%. This can be a significant financial loss if you find yourself in need of cash unexpectedly. Another risk involves fraud and custodial issues. While banks and credit unions typically provide secure accounts, there is still a chance of fraud, especially if your account is self-directed. If you are misled about the nature or value of your investments, it can lead to financial losses. Always ensure that your custodian is reputable and that you are aware of the legitimacy of your investments. Fees and costs are also something to keep in mind. Brokerage accounts can come with various fees, such as account maintenance fees, transaction fees, and fund management fees. These costs can eat into your overall returns. It is essential to understand all the fees associated with your account before you start investing. Additionally, there are limits on employer contributions and plan restrictions. The simple individual retirement account has specific contribution limits and rules for employer matching. Employers must either match contributions up to 3% of employee compensation or provide a 2% non-elective contribution for all eligible employees. These limits can affect how much you can save for retirement compared to other plans. Lastly, there are regulatory and compliance risks. Banks and credit unions must follow Internal Revenue Service rules governing simple individual retirement accounts. If they fail to comply with these regulations, it can lead to penalties or disqualification of the plan. Participants must also adhere to contribution limits and withdrawal rules to avoid tax penalties. In summary, the risks associated with a simple individual retirement account brokerage account include investment market risk, early withdrawal penalties, potential fraud, fees that can impact returns, and regulatory compliance requirements. Understanding these risks can help you make informed decisions about your retirement savings.